So many people hear the word trusts and immediately think of, grand estates, secret family fortunes, that kind of thing.
Right, like something only for the ultra-wealthy.
Exactly. But what if we told you trusts are actually these incredibly versatile financial tools? Tools that can benefit a much wider range of people, especially when it comes to saving on taxes, significantly sometimes.
Hmm.
Today, we're taking a deep dive into this surprising world, pulling from sources like the tax benefits of a trust.pdf.
Yeah, a really useful guide.
Our mission here is to unpack how these legal arrangements can offer some really powerful tax advantages in 2025. And, looking beyond that, too, everything from estate taxes to maybe even impacting your income and Social Security.
And what's fascinating, I think, is just how relevant trusts are right now, especially with potential tax law changes maybe coming down the pike.
That's a key point.
We want to help you understand not just what a trust is, fundamentally, but why it really matters for your financial planning. Doesn't matter what your income bracket looks like currently.
Okay, yeah, let's really peel back the layers on this then. Let's get into it. So at its core, what are we talking about? A trust is basically a legal setup, right?
Yeah.
Where one party, they call them the grantor or settler, hands over assets to another party, the trustee.
The manager, essentially.
Right,
Yeah.
the manager, and they manage those assets for someone else, the beneficiary. It sounds a bit complicated with the jargon, maybe.
It can, but it boils down to those three key roles.
Okay, so break those down.
You've got the grantor, that's you, if you're creating the trust. You set the rules.
Got it. My assets, my rules.
Then there's the trustee. Could be a person, could be a bank. They follow your rules to manage the assets.
Okay.
And finally, the beneficiary. The person or people or even a charity who gets the benefit from the trust down the line.
Simple enough when you put it like that.
And what's really remarkable, I think, is the sheer range of stuff a trust can hold.
Oh, okay. What kind of assets are we talking?
Well, sure, investments in cash, but also real estate, life insurance payouts, even business interests. It's incredibly flexible.
Right. That really highlights why they're not just for, massive Rockefeller-type fortunes.
Exactly. It's about managing different kinds of wealth effectively.
Okay, so that immediately makes you wonder, if they can hold all these different things, how does that actually save money on taxes? Where do we start with that?
Well, the first big split you need to understand is between revocable and irrevocable trusts. They're quite different beasts.
Okay, two main types. Let's start with revocable. Revocable living trust. The name kind of gives it away, right?
It does. You, the grantor, can change it or even completely cancel it whenever you want. Total flexibility.
That sounds appealing. Less commitment, maybe.
It is. But from a tax angle, that flexibility means there's minimal direct tax benefit while you're alive.
Ah, why is that?
Because the IRS basically still sees those assets as yours. You haven't really given up control. So no separate tax return for the trust. Usually, income flows to you.
Okay, so not a big tax saver during life, but you mentioned a benefit.
Oh, a huge one. Avoiding probate. That's the court process after someone passes away to sort out their estate. It can be slow, expensive, and very public.
Right. I've heard probate can be a nightmare.
A revocable trust lets your assets bypass all that. Smooth transfer, saves your beneficiaries time and money, and keeps everything private.
Okay, so best for avoiding court hassles, smooth transfers, privacy. Makes sense.
Exactly.
Now, the other side of the coin, the irrevocable trust. You said it's different. How so?
Key feature here. Once you set it up, you generally can't change or revoke it. There are some very rare exceptions, but basically it's set in stone.
Okay, that sounds restrictive. Pretty final. Why would someone do that? Give up that control?
That's the crucial question. And the answer usually comes down to taxes. Big potential tax advantages here.
How does that work?
Because when you put assets into an irrevocable trust, they are legally removed from your taxable estate.
Ah, so the government doesn't count them as yours anymore when it calculates estate tax.
Precisely. This can dramatically reduce or even eliminate potential estate tax liability, especially for larger estates. And it's not just the current value, it's all the future growth on those assets too. That's out of your estate as well.
No. Okay, so removing it from the estate is the key. Any other benefits?
Yes, that removal also often provides asset protection from creditors or lawsuits. And in some cases, it can help with qualifying for things like Medicaid later on.
So the trade-off, giving up control, unlocks potentially massive tax savings and protection. But I get the feeling there's more complexity here, more specialized types.
Oh, absolutely. Revocable and irrevocable are just the main categories. There are many specialized trusts designed for very specific goals.
Okay, let's dive into a couple of those, maybe ones people might have heard of, like charitable remainder trusts, CRTs.
Good one.
Yeah.
CRTs are interesting. The basic idea is you put assets in, the trust pays income back to you or someone else you name for a set period.
Okay, income stream.
And then whatever's left, the remainder, goes to a charity you've chosen.
That really does sound like a win-win.
Income now, charity later.
It often is. And the tax benefits are pretty compelling. First, you usually get a charitable income tax deduction right when you fund the trust.
Nice immediate benefits.
Second, if you donate assets that have gone up a lot in value, say appreciated stock, you can potentially defer or even avoid the capital gains tax you'd normally pay if you sold it yourself.
Ah, that's clever. Sell it inside the trust structure.
Effectively, yes. So it's really great for philanthropic folks who also want income during retirement and want to leave that charitable legacy.
Makes sense.
Mm-hmm.
Okay, what about another one? Maybe something focused more on passing wealth down. Grantor retained annuity trusts.
CRTs?
Ah, GRATs, yes. These are a bit more sophisticated, often used for wealth transfer.
How do they work?
You transfer assets that you expect to appreciate, maybe company stock or real estate, into the trust. You, the grantor, then get fixed annuity payments back for a set number of years.
Okay, so you get payments back for a while. What's the tax angle?
Here's where it gets really interesting and potentially very powerful. It involves an IRS interest rate called the Section 7520 rate.
Okay.
If the assets inside the GR grow faster than that IRS rate.
Which you'd hope they would if they're appreciating assets.
Exactly. Any growth above that rate passes to your beneficiaries, usually your kids at the end of the term, completely free of gift and estate tax.
Wait, tax-free? The extra growth?
That's the potential magic of a GRATE. If it outperforms the benchmark rate, that outperformance is a tax-free gift. It can be an incredibly effective way to shift wealth.
Wow, so that's best for things you really expect to shoot up in value, like a growing business, maybe, trying to minimize gift taxes on that appreciation.
Precisely. Passing down those appreciating assets with maximum tax efficiency.
Okay. These specialized tools are clearly powerful. Now, let's zoom back out a bit and talk specifically about the big tax categories trusts can impact, especially estate taxes, given where we are in 2025.
Absolutely critical right now. So in 2025, the federal estate tax exemption, the amount you can pass on tax-free is quite high, historically speaking. It's $12.92 million per person.
Per person. So a couple gets double that.
Effectively, yes, if planned correctly. But anything above that high threshold can get hit with taxes up to 40%.
Yeah.
That's a big chunk.
40%. Ouch. How do trusts help here specifically?
Several ways. We already mentioned moving appreciating assets out of your estate using irrevocable trusts. That freezes their value for tax purposes.
Locks it in lower.
Right. Trusts can also help married couples make full use of both their exemptions. Tools like credit shelter trusts or bypass trusts are designed for exactly that.
So you don't waste one spouse's exemption.
Correct. And maybe the most urgent point right now.
Yeah.
That $12.92 million exemption. Under current law, it's scheduled to get cut roughly in half at the start of 2026.
Half? Wow.
So using trusts now allows you to potentially lock in today's much higher exemption amount before it disappears. It's a major planning opportunity, or maybe even a necessity for some families.
That feels like a really crucial deadline then. So let's take an example. A couple, maybe they have assets worth $20 million.
Okay.
If they put, say, $5 million into an irrevocable trust now, before 2026.
That $5 million, plus all its future growth, is potentially outside their taxable estate for good. Even if the exemption drops later, they've already used some of the higher limit. That could save millions in taxes down the road.
Huge potential saving just by acting proactively. Okay, that's estate tax. What about income taxes? Can trusts help there too?
They definitely can, though it depends on the trust type. Some irrevocable trusts, for instance, can be set up to distribute income to beneficiaries.
Okay.
If those beneficiaries are in a lower income tax bracket than the grantor, you could effectively shift income and lower the overall family tax bill.
Interesting, like spreading the income around tax efficiently.
Exactly. Another big one is about capital gains on inherited property, the step-up in basis.
Where the tax cost gets reset to the value at death, right? So heirs don't pay tax on the gains during the deceased's lifetime.
Precisely. Most assets passed at death get this step up. Certain types of trusts, particularly grantor trusts, even though they might be irrevocable for estate tax, can be structured to preserve that step up for the assets inside them.
So the heirs still get that break.
Yes, which can save them a fortune in capital gains tax when they eventually sell the inherited asset. Not all trusts do this, so it's important to structure it correctly.
Good point. Anything else on income tax?
Well, linking back to the charitable trusts we mentioned, transferring appreciated assets to, say, a CRT before selling them lets you avoid that immediate capital gains hit. The trust might sell it, and the tax implications are handled differently within the trust structure, potentially spread out or minimized.
Lots of angles on income tax, too. Okay, what about gift taxes? You mentioned the annual exclusion.
Right. In 2025, you can give away $17,000 per person per year without accounting against your lifetime exemption or requiring a gift tax return.
The annual freebie amount?
Kinda, yeah. But maybe you want to make those gifts, use that exclusion, but you don't want a young beneficiary to just get a lump sum of cash.
Right. Maybe they're not ready for it.
Exactly. So trusts, like crummy crusts, named after a court case, not the quality, are designed specifically for this.
Crummy trust. Okay.
They let you make gifts to the trust that qualify for the annual exclusion, but the trust document controls when and how the beneficiary actually gets the money. Maybe for college, maybe at age 30, whatever rules you set.
So you get the tax benefit of the gift now, but maintain control over the distribution later. Clever.
It's a very common and useful technique, especially for funding things like life insurance trusts.
This is really expanding beyond just estate tax savings, and I gather there are even more benefits, things we might not immediately connect to tax planning.
Absolutely. Think about retirement, for instance.
How do trusts fit in there?
Well, for retirees, trusts can be really helpful in managing income flows. For example, you could have a trust hold Roth IRA proceeds after you pass away. The trust structure can help ensure those distributions remain tax-free for your heirs according to the rules you set.
Keep the Roth benefits going.
Or managing distributions from other assets. A trust can be set up to carefully time payouts so they don't unexpectedly push your income over certain thresholds.
Like the thresholds that make more of your Social Security taxable or increase your Medicare premiums?
Exactly those. IRMAA, the Medicare surcharge. A trust can help smooth out income year to year, avoiding those costly spikes and potentially keeping you in lower marginal tax brackets overall.
That's a really practical benefit for retirees. What about something like long-term care costs, Medicaid?
Yeah, this isn't strictly a tax benefit, but it's huge financially. Irrevocable trusts can be crucial for Medicaid planning. To qualify for Medicaid, to help pay for long-term care, which is incredibly expensive, you need to have very limited assets in your name. By transferring assets to a specific type of irrevocable trust well in advance, there's typically a 5-year look-back period.
Ah, the 5-year rule. You have to plan ahead.
Definitely. But doing this allows you to legally remove those assets from your name for Medicaid eligibility purposes. This means you might qualify for help without having to spend down your entire life savings first.
So you preserve more for your spouse or heirs.
Precisely. And you avoid having to maybe force sell assets like a home or investments at a bad time, which could trigger capital gains taxes anyway. It's about preservation.
That's a powerful protective measure. Now, you mentioned federal taxes, but what about state taxes? They differ quite a bit, right?
They really do. Many states have their own estate or inheritance taxes, often with much, much lower exemption amounts than the federal level.
So you might owe state tax, even if you're nowhere near the federal limit.
Absolutely. Trusts, particularly irrevocable ones, can be just as effective at reducing state-level estate taxes by getting assets out of your name early.
Same principle, different tax authority.
Right. And there's another interesting state-level angle, income tax. Some people set up trusts in states with no state income tax, like Nevada or South Dakota or Delaware.
Even if they don't live there.
Yes, under certain conditions. By establishing the trust's residency there, the income earned by the trust might avoid state income tax, even if the grantor or beneficiaries live in a high-tax state like California or New York. It's complex, depends on the state laws and trust structure, but it can be a significant saving.
A geographic tax advantage, essentially. Wow. Okay, and finally, what about things like privacy and asset protection? Not strictly taxes, but definitely valuable.
Hugely valuable. We touched on probate avoidance with revocable trust that keeps your financial affairs private, out of the public court records. Really important if you have complex assets or just value discretion.
Keeps nosy neighbors out of your business.
Pretty much. And certain types of irrevocable trusts offer robust protection against lawsuits or creditors. If assets are properly held in the right kind of trust, they may be unreachable in a legal judgment against you personally.
So it shields the assets.
Yes, preventing a forced sale to satisfy a debt, which again could trigger unwanted taxes. It's about building a protective barrier.
Okay, this sounds incredibly comprehensive, almost too good to be true in some ways. Which makes me ask, what can go wrong? Where do people mess up with trusts?
Oh, that's a critical question. Because complexity brings potential pitfalls. Probably the biggest, most common mistake is simply failing to fund the trust.
Rename.
You go through the effort of creating the legal document, the trust agreement, but then you never actually retitle your assets, your house, your bank accounts, your investments into the name of the trust.
So the trust is legally empty.
Exactly. And if the assets aren't in the trust, none of the benefits apply. The trust does nothing. It's a surprisingly frequent oversight.
Just a piece of paper then. What else?
Choosing the wrong type of trust for your goals. A revocable trust won't save you estate taxes. An irrevocable trust might have unintended income tax consequences if not drafted carefully. Using a generic template without understanding the nuances.
Needs to be tailored.
Absolutely. Ignoring state taxes is another one. You might structure a trust perfectly for federal purposes, but inadvertently create a state tax headache.
Like that residency issue we talked about.
Right. And finally, not reviewing and updating the trust. Laws change, like that potential 2026 exemption drop. Your family situation changes, your assets change. A trust isn't usually a set-it-and-forget-it document. It needs periodic checkups.
Good advice. So looking forward then, especially with those potential 2026 changes looming, what's the general outlook for trust planning?
The current environment is really pushing proactive planning. With the potential for significantly lower estate and gift tax exemptions in 2026, many advisors are urging clients, if appropriate for them, to consider establishing irrevocable trusts now to use the current high exemptions while they're still available.
Locking in those benefits.
Just exactly. Congress has debated other changes too, alterations to capital gains rules, things like that. All of this uncertainty actually tends to increase the value and importance of having well-designed, flexible trusts in place. As part of a long-term plan, it's about creating certainty in an uncertain future.
Okay, so we've really covered a lot of ground. We went from busting that myth trusts aren't just for the super rich
Definitely not.
to exploring just how incredibly versatile they are. Reducing estate taxes, gift taxes, income taxes, capital gains. It's pretty comprehensive.
It really is. When structured correctly, a trust can shield those appreciating assets from estate tax, potentially lower income taxes through strategic distributions, make sure your heirs get that valuable step-up in basis, allow tax-efficient charitable giving, and protect your assets from creditors and the whole probate mess.
It's about being proactive and strategic.
Absolutely. Taking control of how your wealth is managed and passed on.
And the key takeaway seems crystal clear, especially right now in 2025. With that uncertainty over future tax laws, particularly the potential drop in exemptions in 2026, setting up the right kind of trust now could lock in today's much more favorable tax environment.
That's the crucial message. It's really all about working with experienced professionals, estate planning attorneys, financial advisors, CPAs, who understand your specific situation, your goals, the laws in your state, and the current federal landscape.
Not a DIY project.
Definitely not for the complex strategies, but done right, a trust is genuinely one of the most powerful tools you can have in a tax-savvy estate plan. It helps you keep more of what you worked hard to earn
Yeah.
and ensures it goes efficiently to the people and the causes you really care about.
So perhaps a final thought for everyone listening. Given those potential tax law changes on the horizon, maybe think about what aspects of your financial future, your assets, might benefit most from this kind of forward-thinking planning. Is there an asset you own now that might be worth reviewing through the lens of these trust strategies?